everybody. Thank you so much for joining us today. If you hadn't seen me before, my name is Sam, and I am in client services here at the Retirement Group. I moderate these webinars. Today, we are going to be joined by our advisor, Michael Corgiat, who will be speaking to corporate employees and addressing their most frequently asked questions we've received. These are going to be focused on optimizing your pension, amidst rising healthcare costs, changing interest rates, and inflation. Before I bring Michael on, I would just like to remind you that although we work very closely with many corporate employees of many companies, we are not affiliated nor endorsed by any specific company. The Retirement Group is a completely independent group of financial advisors. And with that, I'd just like to bring on our speaker today, Michael Corgiat. Hey, Michael.
Hi, Sam. Thanks, everyone, for joining us today. I do appreciate it. We're going to discuss some very frequently asked questions today, which I appreciate and smile when I see them over and over and over again. But like Sam said, I am one of the retirement advisors here at the Retirement Group. We're a firm who's worked with a number of Fortune 500 companies for a long, long time. We specialize in knowing their benefit programs and helping you to take advantage of the best times to retire and what's the best way to take your benefits. These on-demand webinars are just one of the many resources that we offer individuals like yourself. We also maintain an ebooks library. We have our own retirement guides for all the employers that we work with. So all you have to do is reach out to our office and we'd be happy to email you one. I think one of our probably finest, most important resources that we offer is our retirement cash flow analysis, our retirement plan. I like to call it a roadmap. It's a complimentary service. It's something that we would be happy to put together for you. You just have to ask us for it. It'll give you a good idea of where you are at currently and whether you'll be comfortable retiring, whether it's a month, a year, 5 or 10 years from now. And again, it's a complimentary service, so all you have to do is ask for it. We are a team. We operate as a team. We work together as a team with lots of years of experience. We've got offices all over the country. I am here in the Midwest in St. Louis, and I have clients literally from coast to coast. I've already touched on our knowledge of your business and our complimentary financial analysis. So let's go ahead and dive into today's questions. Our first question is, can you please explain the benefits of the HSA increase? All right, good question. What is an HSA? It's a healthcare savings account. It's your healthcare IRA, I like to call it. The limits this year for an individual are $3,850 for an individual, and $7,150 can be contributed for a family. By the way, this is a pre-tax contribution. For the most part, all of your employers offer HSA plans, and in many cases, your employer will give some sort of matching contribution if you participate. I am a huge fan of HSAs. I personally have one myself, and it allows you to set additional monies aside to help take care of healthcare expenses when you get old. And we're all going to get old, and let's hope we all do get old, okay? Definitely contribute to one of these programs and try and maximize it for yourself and your family. The increase that's asked for in this question is essentially each year, the IRS mandates an increase in the amount that you can contribute to an HSA. And by the way, if you're over 55, those limits are also increased by $1,000. It's a catch-up contribution. I can't say this enough. You should and can, for the most part, participate in one of these programs. Having that money set aside on a pre-tax basis, and when it's used to pay eligible healthcare expenses, it's tax-free. You don't pay tax on the growth. So definitely take advantage and hope that helped answer that question. Our next question, what ways can I plan for a rise in healthcare costs? Another great question. Retirees, the age of 65, if they expect to live to their normal life expectancies can expect in the neighborhood of $175,000 in premium and healthcare expenses for the rest of their lives, basically through their normal mortality, and twice that, or 350,000 for a couple in retirement. An HSA is one of the best ways you can help defer or defray medical costs. All right. I do a lot of healthcare work for small business owners, and there are other things that you can obviously do. You can review your medical plans, and pretty much you have to year after year during open enrollment. Check your deductibles. If you're healthier, you can lower your costs by raising your deductibles and your out-of-pocket limits. The same thing for your prescription drug benefits. I've seen huge value in just looking at whatever prescriptions that you've taken or have been taking or will be taking. A lot of people take maintenance medications, and there are generics, which are a lot cheaper than brand name drugs out there. And you may be taking a brand name drug, and there may be a generic that would be a fraction of the cost to lower your expenses. All right. I'm a big fan of what I like to call preventive maintenance. All right. Go see your doctor on a regular basis. Get regular checkups. The Affordable Care Act allows us to do that, and it's covered at 100%. So go see your doctor. Make sure you're doing well, rather than waiting for a problem to arise and then some big expense that you have to incur. All right. So, take care of yourself. If you smoke, quit smoking. If you drink too much, quit drinking so much. So these are just some of the simple things that you can look at to reduce your overall healthcare expenses. But it's something that you're going to have to look at diligently year after year after year. And if your situation changes or if your health changes, you may have to look at what plan you're utilizing, what deductibles you have, and so on. But these are just some of the few things that I would suggest that you look at to keep your healthcare costs in check and to keep your premiums down. Once you reach Medicare, you're going to have to pay for Parts B and Part D. And then you're going to want to look at supplemental coverages, either a Medicare supplement or Medicare Advantage policy. The differences with Medicare Advantage policies are usually less expensive, but you are in many cases limited to just using their network, solely their network of doctors and hospitals. Healthier people sometimes benefit better with an Advantage policy versus people that may have some issues going on, and they're better off with a supplemental policy. They do cost a little bit more, but they do have a lot more freedom as far as your doctor's visits and your hospitals where you might go. So keep all those things in mind. Okay, question number 3. Interest rates are all over the place. Boy, that is true. I am 60 and on the cusp of retirement. Do you think I might fare better waiting until next year? This is a great question. Many of you have an option to take your pensions in the form of lump sums. You can either take a monthly annuity or a lump sum benefit. Lump sum benefits are affected by interest rates. And I'll use an example of AT&T. I do a lot of work with AT&T employees. Interest rates for last year's lump sum calculations were at historical lows. So lump sums were at historical highs. And the Fed has been raising rates for upwards of 14, 15 months now, and now interest rates are at historical highs. So the interest rates that go into pension calculations for this year are much higher than they were for last year. All right. The Fed is raising interest rates primarily to slow down spending and to slow the economy down and try to get inflation down. And it's working. Now, thankfully, hopefully you're not having to go out and borrow money to buy a house right now because mortgages are at 7%. All right. But you're getting more money on your passbook savings. Is it better to wait till next year versus this year? Well, interest rates are high. Chances are they're going to stay this way for at least another year and possibly 2. I can't say that for a fact, but I used AT&T as an example. Their rates are determined for the next year in November of the previous year. We know where these rates are going right now. They're staying high. They're pretty much in the same area as they were from last November. I can't predict where they will be this November, but chances are they'll be in the same range. So it might make more sense to wait till next year. It might even make more sense to wait till 2025. Just reach out. We'll be happy to discuss how your plan works, how interest rates affect you specifically, and whether it might make sense if you want to retire this year, whether it's a good idea to take your lump sum this year or wait until 24 or even possibly 2025. Okay. How can I use my HSA funds to pay for long-term care expenses during retirement? Great question. You can use your HSA to pay for both long-term care coverage, which is something that everyone should consider while they're healthy and they can still get it, as well as many eligible expenses that long-term care that you would incur with a long-term care. I want to quote a couple of statistics. Right now, long-term care expense, or basically the expense of either being in an assisted living facility or a nursing home, the average costs are between $3,700 and $7,700 a month right now. That's a lot. Long-term care coverage, long-term care insurance is a great idea, and there are many options that you could consider. We certainly can help you with that. You can pay those premiums with the funds from your HSA. And obviously you can, with many eligible expenses, can use your HSA to pay those expenses as well. Okay. And our last question. Good question. I'm 62. Can I collect my Social Security benefits if I live outside the United States and still work at my company, and would they be taxed? Great question. Well, first, yes, you can collect your benefits if you're out of the country, obviously if you're eligible for them. This individual is 62. They have the option to start their Social Security benefits. Now, if they're still working and they're earning more than $20,000 a year, they could lose those benefits because taking early retirement benefits are reduced with earned income prior to full normal retirement age, which for the most of us is between the ages of 66 and 67. So yes, you can take them if you're eligible for them. You want to be careful if you take them early. And yes, finally, they would be taxed. They're going to be taxed as part of a portion of all Social Security benefits are subject to income tax, either 50% or up to 85%. It is based on your overall taxable income, whether it's active working income and or passive retirement income. You need to consult a tax professional just to find out what your situation looks like. And finally, let us put together a retirement plan for you, one of our retire kits. We'd be happy to do that. So I believe those are all the questions that we have for today. Yes. If you have any additional questions or would like to schedule a call with myself or one of my colleagues, all you have to do is scan this QR code and you can schedule an appointment with any one of us. You could give our office a call at 1-800-900-5867. We didn't get to something that you were interested in, please reach out to us. By the way, you can also send us an email at info@theretirementgroup.com. I do really appreciate everyone joining us today. I hope my responses to these questions have been helpful. I really enjoy doing these presentations, and I look forward to seeing all of you at the next one. Have a great day.